Hello and welcome to this MithrilMoney Securities Investment 101 course and the second part of our types of share lecture. Okay, we just need to explain a few more things about this liquidity kind of ranking chart. So let's do that. So remember last time we had debt down here. We'll kind of colour that in. So that's debt there, bonds, etc. And we've got preference shares here, and we've got ordinary shares down here. So on this side, we have kind of debt, and on this side, we have equity, or shares, or kind of ownership of the company. You know, you're involved with the company, whereas the blue people at the top there, they're just lending the company money. The people in yellow down the bottom here, they are part of the company, so they are providing share capital and so on. Okay, now we just need to realise that we go from seniority up there down to being, most junior down here. And as you can see from that, what that means is that preference shares are therefore more senior than ordinary shares. Now, there's a special equation. It's called Jensen's inequality. And that's nothing to do with Jensen Button's need for a faster McLaren car, which basically says as risk goes up, reward should also go up. And if we kind of rephrase these terms, what we're saying here is that this is low risk at the top here, the most senior, going down to high risk. So we start at the top, the most senior debt here. This would be senior secured debt, which is probably better if I make this a bit neater. I'll break the debt up into three lumps. So we've got secured debt, unsecured debt, and we'll have subordinated debt here, subordinated debt there. Now they're all debt, they're all bonds. Now if you remember from the introduction video, the secured debt would be if the company fails, that loan is secured upon something. Often it's companies, buildings, kind of real estate. It can be aeroplanes. It can be ships. Huge liquid natural gas carriers and so on. But this secured debt will be secured against an item. Think of you go to a pawn shop, a PAWN, pawnbroker's shop, and hand in your watch, which is worth $200, and you get given $100. And if you come back within 2 weeks, you get your watch back, with $110. But if you don't turn up with $110 in a couple of weeks' time, then the pawnbroker will keep your watch because that was their security. That was their that was what they secured the loan upon. So that's the most senior. And then unsecured is if there's any money kind of left over, then you'll get paid off there in the company. And subordinated is even riskier than unsecured. So that comes underneath unsecured loan stock. So the unsecured stuff is sometimes called loan stock, and then we have the subordinated loan stock as well. So this is just unsecured loans stock would just be the bank lending me money just on my name and my reputation that I'll pay it back. Okay, so let's get back to the main point of where I was. I kind of went off the track there. So senior, junior is the same as low risk to high risk. And if we then apply Jensen's inequality, what that also means is that those two things there, I'll just kind of, what I'll do is I'll just grab hold of this and I'll shrink it a bit and move it somewhere. So if as risk goes up, you must expect more reward, not be guaranteed it, but you take more risk. You put all your money on red on a gambling table. You might lose all your money if the ball lands on black, but if it does land on red, you'll get double your money back. So what we're going from here is low reward to high reward, or high expected reward anyway, mathematically expected reward. You know, given 1,000 investments in stock with certain risk levels, then you should expect to get more reward. So we go from low reward to high reward, which is what Jensen's inequality there is telling us. So we'll just write that down again. It's nice to have these things kind of recorded, isn't it? Jensen's inequality. Okay, so now I'm simplifying this massively, but we're forgetting capital growth, we're forgetting the capital price of stock rising, and so on. We're just going to look at cash flows, and we're going to assume, what's going on there? My HP support assistant. No, cancel. Don't want to do that. Go away. So we're going to assume that there's no kind of capital growth problems that we're going to worry about, and the price of stocks and so on going up. So what we're going to do is assume just cash flows. If this was a, say, 3% cash flow, it's low risk because it's got the greater security and the greater seniority, then the unsecured loan stock should pay more. Let's say 4% fixed coupon on a $100 loan. You should get $4 a year. The subordinated loan stock, which is, you know, being paid after the unsecured people have been paid off in a liquidation, should receive more because as risk goes up, then rewards should go up. So they'll be paid, say, 5%. Now, the preference shareholders, it's a strange thing. It's a kind of hybrid, really, between stock and bonds because it has this fixed coupon, remember, on a face value, is lower risk than the ordinary shares, but higher risk than any of the debt stuff. Because the yellow stuff can only be paid off once all the blue stuff has been paid off in a liquidation. So the preference shares should pay higher rates than the subordinated loan stock, given all other things being equal. The ordinary shares being at the lowest point of being paid off, the most junior thing that there is, at the highest risk, should get the highest reward. So all other things being equal, they would have a dividend payout kind of rate of 7%. Now that's just, you know, that's not reality. That's just me trying to make a nice picture out of something that can get quite complicated. So the ordinary shareholder should expect the highest reward because they're taking the greatest risk. Now, how this would work, let's say the company does get liquidated. So if the company does get liquidated, let's say the company has $100 worth of assets and the company gets liquidated. A liquidator will be appointed by a court, usually, or in some way. So a liquidator will come in, and the liquidator will always be paid off first. So why would you go to the bother of sending people around to a building to lock it up and secure all the aeroplanes and so on, and sort out the company's finances if as a liquidator, if you're not going to be paid? So the liquidator of a company will be appointed usually by a court in some way after the bondholders have sued the company for not paying them their coupon payments or whatever. The liquidator will be appointed by the court, will come in and will pay themselves first out of any of the company's assets. So let's say that they determine that their fees, the court might decide this, their fees are worth $5. Okay, so they're going to pay themselves $5 out of the company's assets of 100. That means there's $99 left. Sorry, not 99, what I'm talking about. $95 left. Okay. That's not very neat, is it? Let's say, just for the want of argument, that all the bondholders here, all of them, are owed $74. I mean, in real life it might be $74 million, but let's just go with it. Let's just go. Let's just ride with it, baby. Okay, so they're owed $74 million. So they then get paid by the liquidator. So the liquidator sends them all a check. Okay, that takes our $95, if I got my maths right, 91, take away 70, $21 left. So there's $21 left of assets that the liquidator is going to distribute. Now, who gets paid next? Well, we can see low risk seniority. Okay, it's got to be the preference shareholders. And let's say there are 20 preference shares, all with a face value of $1. I won't draw all 20. Let me just draw 3, and we'll just imagine the other 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Let's imagine there are 20 preference shares with a face value of $1 each. Well, the preference shareholders will then be sent $20. There'll be 20. Let's say one person owns all the preference shares, and they're all worth face value $20. Then the preference shareholder will be sent a check for $20. Okay, that leaves $1 left. Often, of course, when a company goes bust, the company has no money left at this point. In fact, it often doesn't have any money much beyond the secured people, but let's just imagine that this is the case. So there is $1 left. Now, most of these people have been paid off. Liquidator's been paid off. These people with the $5. All these 3 people lumped together have been paid off with $74. The preference shareholder's been been paid off with $20. There's $1 left, and there's 1 person left. Now let's imagine that there are 100 ordinary shares. Okay, so there's 100 ordinary shares with a face value of $1. I'm not going to draw 100, so we'll do 3, 4, 5, and then we'll kind of imagine that there's another 95 shares. Okay, so there are 100 ordinary shares in this company, each share representing 1% of control, of voting control. There's $1 left. Now, nominally, if you collect all these things together, there is a face value altogether of $100. Across these 100 shares with a face value of $1 each, and there's $1 left. So we have a bit of a Houston, we have a problem. So what we're going to do is we're going to send all of these people 1 cent each. And we're going to send them 1 cent each. So they're going to get 1 cent. Oh, let me redraw that. They're going to get 1 cent. They're going to get 1 cent. And all these people, these 100 shareholders, are going to get sent 1 cent each. Because they're all, all the ordinary shares in this case are all the same ranking and everything. Same kind of seniority. That would be called a 99% haircut. So a 99% haircut. If you just draw it, it's getting a bit untidy, this diagram. So if I just try and neaten this up a bit. Okay, so we've got 1 ordinary stock share, face value $1 in Andy's fish sauce company, and I get sent 1 cent or $0.01. I've basically got that much back. Okay, so I've received 1% back of my face value, and I have taken a 99% haircut on the rest. So all of that has just disappeared. It's a bad investment. Okay, so here I am going into the barbers. Okay, so I go into the barbers there, and I come out, and I'm a bit sad because I've got 1 hair left. I had 100 hairs on my head when I put $1 in. Face value, remember, I could have paid $25 for this share with a face value of $1. So I've already lost the 24, but I don't even get the 1 back. I just get 1 single solitary hair back. I've lost 99%. So I've had a 99% haircut. Anyway, that's how that would work. So I'm taking a huge haircut there. There we go. Now, it could be even worse for me. It could be even worse for me. Let's draw another diagram while we're here. And we'll just lump all the debt people into one lump. because they're not really relevant at this stage. Okay, so we got the preference share people. And they're more senior to the junior, the more junior ordinary stock people. Now, there could be a special thing called a liquidation preference. Imagine that by the time we get down to this point here, there's, say, $3.50 left in the company. And there's just two shares here. There's one preference share with a face value of $1, and there's one ordinary share with a face value of $1. Now, I know the company wouldn't be going bust if there was this much money left in the company and there was only these two shares. But let's just, if you can just ride with it for a second, so we can make the point that this looks okay. So the ordinary person is pretty happy. They think, well, there's $3.50 left. There's somebody's going to come in ahead of me and take $1 away. There'll be $2.50 left. I'll receive the. I'll get at least my $1, and in this strange, bizarre universe that would never exist, I might get the whole $2.50. But no, that's not what's going to happen in this case, because a cunning not evil, but just cunning angel investor. So we'll put a halo on them. An angel investor came in at the start of this deal and bought this original preference share and said, what I would like is I would like a liquidation preference of 3 times, because these angel investors, they're like frog collectors. What they do is just try and capture my, can I capture my, oh no, I've just lost bits of it. So let's just redraw my angel investor up here. So my angel investor will invest in 100 frog spawns. Okay, so investing in hundreds of frog spawns in the complete and full knowledge that 99 of them, or 98 of them, are going to fail completely. So they put some money into lots and lots of different companies, knowing full well that most of them are going to fail because they're brand new companies, brand new startups, but with the hope and the expectation that occasionally they're going to get a Facebook, or they're going to get a Google, and they're going to get a giant. I'm not the best artist in the world, as you already know, but they might get this kind of giant frog type thing called Google, worth, they put $100 into 100 different companies, or $100 million into 100 different companies, $1 million each, and then this one is worth, I don't know, $100 billion. So anyway, the angel investors are very like these liquidation preference shares, and they like to have a liquidation preference which is higher than 1. So they'll say, I want a 3 times liquidation preference. So if the company should go belly up, then my face value of $1, if there's sufficient money left, and there is in this case, will be turned into $3, even though I only paid, $1 for the share, let's say. Let's say they paid the face value for the share. So they've paid $1 million here, and they've got back $3 million. That was handy, wasn't it, by buying these special preference shares with this liquidation preference of 3 times. Because what that means is, for the poor old ordinary person here, there's only 50 cents left. So they'll take a 50% haircut, and now they won't be happy anymore, will they? They'll be, actually, it's not too bad, so I won't make them sad. I'll just make them neutral. It's not too bad getting a 50% haircut if a company gets liquidated, but there we go. So do bear that in mind too as well. Now, so far we've been talking about really bad things. Let's about liquidations and so on. Let's talk about some good things. So, in some good things, let's imagine things are going well. You made a good investment this time, and there's huge profits. So, huge profits. Well, if that happens, then if a company does well and earns these big profits, then there'll be an AGM. So here's the company and the company board, and they'll organise an AGM, which is an annual general meeting. And they'll do it in a swanky hotel. Let's say they do it in a swanky hotel in Paris and draw the Eiffel Tower. I don't know if that looks like the Eiffel Tower, but it kind of... So I kind of imagine it in my strange head. Okay, there's the Eiffel Tower. They organise this annual general meeting in Paris. Everybody's happy. And they award themselves a nice big fat dividend. So a huge dividend goes to the ordinary shareholders who are all, say, one's holding $1 share. Very, very happy. Company makes lots of profits, pays out a dividend. Ordinary share person, very, very happy. But remember, they can only receive something, these ordinaries. Do bear this in mind. These ordinary people can only receive something if the preference people have been paid off in full. So if our angel investor from earlier is holding this $1 share with a 7.5% payoff thing, that they have received their 7.5 cents, 7.5 cents there, because that's what they're supposed to be receiving per preference share. So ordinary people only get paid off if the preference people have been paid off in full. Now, we'll just tackle one more topic before we wrap up for today. What I'll do is I'll talk about a thing called A and B shares. So now we're so let's just draw this overall diagram again. So we've got debt, we've got preference shares, and we've got ordinary shares. I'm going to scrub the debt people and the preference share people. We're only now talking about ordinary shareholders. I think we'll talk about more about preference shares in the next lecture, because it's getting to be a bit long, this one now. So here's the ordinary shareholders. Now let's imagine I start my Mithril source company up, and I've got 8 shares. Okay, so what I'll do is I'll just quickly copy those. Copy and paste. And then I'll copy and paste those. Oh, high tech this. High tech. So I've got 8 shares, and this is Andy's Fish Sauce Company. So there's the company over here. There's Andy's Fish Sauce Company. I've got 8 shares. Now these are just standard ordinary shares. And then what happens is I go to a special program called, I don't know, we'll call it Dragon's Hideout or something. So I go on a special TV program called Dragon's Hideout. And a rough Australian billionaire says to me, Andy, I want to put $1 million into Andy's Fish Sauce Company because I love your product. So I'm going to give you 1 million to invest into your company, to grow the company, grow the brand, etc. But in return, I would like 2 shares. Now these are going to have a face value, $1 each, but all those red shares you can see at the top of the slide, your 8 shares, you still get them, but you have no voting control. All voting power resides in these special shares. Now, there's lots of different kinds of shares. You can have S shares, you can have in Singapore, I think, you can have H shares in Hong Kong, you can have all sorts of shares depending on your stock exchange, your company, your country, whatever else. But we'll then, in this case, we'll have 2 kinds of shares, and they're normally called, depending on the conditions, A shares and B shares. So in this case now, I agree to this because, I want this rough Australian billionaire to help me and to give me $1 million to help me grow the company. There's now 2 classes of ordinary shares here. We've got the A shares at the top. Let's not do that in orange. Let's do that in, what colour have I got there? Is that blue? So we've got the A shares. Let's colour them all in blue. So there's the A shares there. And we've got the B shares. And we'll do the B shares in yellow. Okay. Now as I'm a believer in Austrian economics, we could spend hours talking about the difference between ownership and control. But just to keep life nice and easy, let's just imagine for now that I still own, here's me, I still own 80% of the company. So I own, and we'll leave a debate on ownership versus control to to an advanced lecture on Austrian economics. I own 80% of the company. But I have zero control. I control nothing. And my rough Australian billionaire, let's try and draw a dragon. What does a dragon look like? Scales and stuff. There's the hideous eye, Smaug. Yeah, it's not a very good dragon, but it'll do. Anyway, that dragony person there, they own 20% of the company, but they control 100% of the company. Now, both sets of shares, both the blue, let's colour it in so we get the colour coding correct, a yellow dragon. Both sets of shares, that both the blue and the yellow, get the same dividends. So if 5 pence is paid to the yellow dividends, 5 pence is paid to the blue dividends. So those blue ones still have a cash flow, and technically, legally, there's still a level of ownership there for the blue person, which is me, the original founder of the company. But the yellow shares vote. Now, sometimes the A shares will have a time limit. It might be, say, a 5-year time limit or a 10-year time limit. So the rough dragony person here will get 5 or 10 years or whatever of total control, and then it will revert back to the original situation where all the shares then become equal again. So let's not try and redraw all of that. Okay, let's just get rid of A and B. So after 10 years, there is no distinction between the two sets of shares. After 10 years, they all revert to being the same class of shares. So that can happen too. And if that does happen, after a certain period, I now own 80% and control 80%, and my dragon character there owns 20% and controls 20%. So that can happen with ordinary shares as well. We get these different classes, often called A and B. You can have C shares, X shares, Z shares, whatever kinds of shares you would like. But I think that's enough for now. I think we've spent long enough on this. We'll do some more on preference shares in the next video, so look forward to that. Before then, if you would like to contact MithrilMoney for private financial training anywhere between London and Singapore or points beyond, I've always wanted to go to Hong Kong, and I've got friends in Singapore who regularly go there. Please contact us via the contact link in the YouTube show notes. Anyway, we'll see you next time.